getting married here.
Check. Maybe. Is that turning anything down? The music, maybe?
Or did it just get quieter on its own?
I don't know. Guys, you don't have to be tech smart to be financially smart. I'll just hold this a little further away. But I just wanted to welcome you guys here to our very first Lunch and Learn, which is super exciting. So let's give yourselves a round of applause for being here, for being the ones that go first. I love it. So if you don't know me, my name is Charity Majors. I am the founder of Business and Bubbly, which is a group of women who love to get together, who love to grow community, who love to really create and foster business connection, because we believe that life and business shouldn't be done alone. And financial literacy is a big topic that we really wanted to go over. One of our mantras in Business and Bubbly is that when money gets in the hands of good women, great things happen, right? Does that resonate with anyone? Yes, I love that. And what's really interesting about the financial world is that women actually control 80% of the financial decisions in a household. And obviously, how many of us have businesses? Yes, love it, right? So we are obviously making those financial decisions for our business. And this is a really passionate topic of mine, as well as our speakers that we're going to be hearing from. So I'll bring them up in just a second. But before we get started, I actually want to invite a couple of you guys. None of us bite, and so if anyone wants to come sit up at the front, we've got a couple of gifts for you. This is actually it's a 5-minute daily gratitude journal that I published, and then this is a Goal Getter Planner Plus journal. They're on Amazon if you want to grab it, but if you want to come sit in the front, yeah, girl, come get it. You get it to be a front seat, girl. You get one of my books.
Yeah.
Super fun. And while I turn this around, because branding. We also want to welcome our online viewers that are streaming in, and I'm going to bring up our speakers. So Molly Arnott, she is an amazing, not only realtor, but she's really passionate about investing when it comes to real estate. And we are going to hear a deep dive into some fun things like house hacking and what it looks like to be able to buy a property and pull money out and invest it into another one. So how many of you guys are really excited about real estate investing? Love it. So we'll bring up our next speaker, Viorica Wakelam. This woman is a powerhouse. She is really passionate about especially equipping women with financial literacy to make savvy decisions for their future. So we're going to be talking about stock market and just being able to make smart decisions regarding having your money make money for you. And then we're going to bring on another special guest here. And Katie. Oop, I just muted myself. All right. Katie Maddox, she is the founder of Millennial Accounting, and she is going to be chatting about making smart tax decisions for your business, as well as really knowing your numbers. And then we have a really fun exercise for budgeting for business growth. Because how many of you guys know that there's a difference between budgeting, like just to kind of maintain, versus budgeting for growth? Okay, so we're going to be chatting about that and breaking down some of those numbers as well. So if you guys want to go ahead and have a seat, let's give our speakers a really big welcome and round of applause. Okay. that is yours. Thank you, thank you.
You don't need to use that with your number.
And we are going to hear from Molly first. And let me pull up her presentation. Yeah, you can totally stand. You can use that if you want it. It's kind of hot, kind of loud. Hot. But it will be good for the online people. So yeah. Okay, cool. All right. Well, I'll try to list in front of you guys, but I do like to move. My name is Molly Arnott. I am a real estate agent and an investor. I was an investor first. I kind of found myself. Actually, you click to the first slide for me.
Yep.
I kind of found myself stumbling my way through real estate investing in the beginning for like a decade. And, we just happened to really like fixing up houses. So we buy one, we fix it up, we move on to the next one. It happened to be the '08 crash when I first started. And so the first house that we had fixed up, we couldn't sell and make any money. It would cost us money to sell it. So we kept it as a rental. And now we were landlords, and that was like a new version of doing this. And that actually ended up happening a couple times where we got ourselves in a position where we ended up having to hold a place, but it cash flowed, and so we kept it as a rental. Kept doing the live and flip thing, finally did a professional flip, and then in 2018 decided to get my real estate license and go all in, and dive right in. And I found Bigger Pockets, which I will talk more about resources, but Bigger Pockets is an amazing resource for real estate investing, and so that's kind of what really pulled me in and had me get going. So that's kind of a little bit about me. Keep me on track. So the basics. So what is real estate investing? The simple answer is just investing in a piece of property, real property. Doesn't mean it has to be a house, doesn't necessarily mean it has to be, there's lots of different ways you can invest in real property, but even arbitrage is a strategy that some investors use, and that doesn't even require you to own any real property, but it means investing money into some type of real property that brings you back a return. So that's kind of the basics. And why? So everybody has their why. For me, it was financial freedom. I'm married to a serial entrepreneur, which has its pros and cons and its ups and downs. He's a wonderful man, and he has done some amazing things over his our 15 years together. But we've also had lots of hardships and times where money was real tight and we didn't know what we were going to do. And so part of that 2018 for me, when I got my real estate license, was like, okay, Mama's grabbing the reins of this, and it's time for me to step up and take care of my family and provide and give that consistency. And so I was the driving force of really wanting to go all in on the real estate investing and really do that. And so I got my license specifically to make extra money to invest in properties and be able to, make a little deal because I'd be the realtor representing myself. And so that was kind of what started for me. But I think it's really important if you decide to get into real estate investing is to get really, really clear about what your why is. And keep that at the forefront, because it's really easy to lose sight of why you're doing these things. When you could buy a brand new shiny car instead of buying a beater duplex. It's really important to keep that at the forefront, what you're really up to and what your goals are and what that's all about. So I stay focused on the why. So investing objectives. So everybody has their own vision of what they want to, why they would want to invest. And so these are kind of the two main reasons people invest, is for appreciation or for cash flow. And then there's also kind of doing both and getting the middle ground of both. That cash flow means you're basically buying an asset that is going to then be giving you a monthly income from that property. So the most traditional way to do this is to buy a house or buy a duplex or buy an apartment complex, and you're making more money than you're spending on your debt on that property. That's your cash flow. So not all markets are created equal. So, for example, Idaho used to be a great cash flow market. We're not anymore. That has changed, unfortunately. We are now more of an appreciation market. If you stick your money in something, the chances are in 10 to 20 years, it's going to make you a lot of money. So knowing your market and knowing what your objectives are is really important. So for folks who have a great job or they have a business they love and they are full on in that, real estate investing is something they want to do on the side to grow wealth, then usually they're going to be more on the appreciation side. They'll probably buy high-end assets, things that are going to require less maintenance, be easier, and they know their money will grow invested there.
Whereas cash flow markets, usually you're going to want to invest for cash flow if you are focused on like replacing your income. If you want to work less and have your money go out and work for you so that your time is less of a demand, cash flow is a big thing to focus on. And obviously, like locally, we can still get a little bit of a blend. If you find the right property that has a value add opportunity, you can get a little bit of that blend of, you're gonna get appreciation, you can maybe squeak out a little bit of cash flow, not anything like to get too excited about, but yeah. So that's kind of, I think it's important when somebody says, well, is now even a good time to invest? I'm like, it depends on what your objectives are, like what your goals are, like what you're up to. It is such an individualized thing. I'm sure you would say the same thing when you're talking to people about investing. It's so important to get clear about like what you're up to, why you want to do it, and figure out what the best plan is for you. Okay, let's go to the next slide then. Okay, so getting started. So real estate investing, everybody usually tells me the biggest barrier is like the first step. Like what is the first, how do I get over that first barrier? Like how do I get in? So if someone is open to it, I usually say house hacking is the easiest way into real estate investing. That means you're using your own primary residence as an income property. So that could be that if you already own a home, you could add a unit to it, like an ADU, or even rent out a room. Some people do. I mean, it depends on your comfort level. But turning an asset you already own into an investment property, or going and buying an asset that is an investment property that you live in. So when you own or occupy a house, it is depending on your qualifications, you can usually get down to like 3% or even sometimes 0% down with the Idaho housing loans. So your money out is little to none to get into that property. If you buy a duplex, triplex, fourplex, you can live in one unit, rent the others. You can add an AD. I mean, there's all different ways to do that, but it's basically using the home that you're going to buy with that low down payment to get into that first property. That's one of my favorite ones to promote. A HELOC, or using equity from an existing property, is another real popular kind of first investment. So if you own a property that there's not much equity, if you own your home for more than 2 years, you're probably sitting on much of equity. Pull that equity and use that to go buy an asset that then brings you more income. And obviously, it's all about the numbers. I'll say that all day long, but know your numbers, run your numbers, and get really, really clear on that, because that is the most important thing. Especially when you go to pulling out equity, you want to make sure that the money you're pulling is justified with the money you're making. You want to be making cash flow, you want to be making money over the top of the new debt. So those are kind of the two most popular ones. Creative financing is another, kind of keyword, I'll say, that's really popular right now, and most people are kind of like, yeah, but what does that really mean, and how realistic is that? And it is realistic. It's harder to find, but they are absolutely out there. I actually just closed on a property last week that is what we call a subject to deal. So subject to means that the buyer purchased the home subject to the seller's financing. So the loan actually stayed in place in the seller's name because they couldn't sell the property and make any money. They were going to lose money if they had to sell it. And so they took over that loan. They got that seller's interest rate, and they put the deed into the buyer's name. There's risks involved on both ends in a deal like this, but it is a creative solution that when a seller's in a spot and needs to get out of a property, and a buyer wants to scoop up an opportunity to get into a property they couldn't otherwise, there's kind of these creative solution, owner finance type deals that sometimes hold together if somebody's looking for a creative way. Moving on to your current home, that's another really popular one. Keep the house you live in, or keep it as a rental, turn it into like an Airbnb or some other type of income property, move on and buy your next family home. That's probably the most comfortable one that I think most young families will do, is that they'll keep the house that was their starter home, and then they'll go buy the next home. So those are kind of the most popular getting started, ways of starting into real estate investing. Go to the next one, and then tell me if I'm going over. So investment strategies. There are so many more. These are the ones that I would say are probably the most popular, that people talk about the most, so I'm just going to kind of start there. So fix and flip is kind of your standard. You buy a house that needs work done to it, you fix it up. There's a nice buffer between what you have put into the property and what you can sell it for once you fixed it up, so you make money on that, profit on that sale. The BRRRR method, this one's a little less well known, but I'm a really big fan of it. I've used it personally. It basically means you're flipping the house to yourself. So you buy a house, at a discounted price. It stands for buy, rehab, rent, refinance, repeat. That's what the BRR, if you guys want to say that again, well. But it basically means purchasing a property, fixing it up, renting it out, so now you have a lease on that property, and then you refinance the property because you can now show the higher rents that you're getting because you fixed up the property. When you do the refinance, they will do a new appraisal on the property, and if you've done your numbers correctly and you've increased the equity enough, in a lot of cases you can pull your equity all the way out. Like I have a property in Parma right now that I'm doing a refinance on that I'm actually going to make money on that refinance. The amount of the purchase price plus all the money I put into the property, now when I refinance, I'll actually make profit and it'll still cash flow. It's all that. Those are the ones we get excited about, so that's the BRRRR method. I love it because it actually allows you to grow the fastest. Because your money isn't stuck, you don't have equity stuck in a property. The money you actually put in, you take back out. You can now go buy another one and do it again. They're not the easiest properties to find. I kind of call them unicorns, but they are absolutely out there and it can be done to increase those rents and make those numbers all work. But that's one of the fastest growth hacks I think most investors are using is some type of that. Long-term rentals is just a traditional buy a house, rent it out to a long-term renter. Short-term rentals, it would be like Airbnb, VRBO. We have a few of those. I really enjoy the cash flow that you can get from a short-term rental. A long-term rental return is going to be a lot lower, but also a lot less maintenance. You don't have to do much. You put a renter in there, and as long as they don't trash the property, which happens sometimes, there's a lot of easy with that. Where short-term rentals, like you're talking to people every week. I mean, there's a lot more maintenance and things involved, but the increase in cash flow is really nice. It's usually in the 25 to 35% more than you'd be making if you were doing long-term rents. So, house hacking, we've already talked about that a little bit, making money on the house you live in. Syndications is where basically people pool their money together and they go buy bigger projects together. This is usually a very passive way of investing. It's very convenient, especially if you are a busy, entrepreneur in your own right and you don't have time to be thinking about, dealing with a tenant or things like that, and you want to offload that. Syndication can be a great way to make returns and invest your money into like larger pools of buying bigger projects. We have a great guy locally who does a lot of syndications and a lot of great opportunities there. The returns are usually a little bit less. So these are the resources I would say are the greatest places to start. Obviously, I love being a resource for people. I got my real estate license to do investing myself, but then found I also really enjoyed working with investors, and so I would love to be a resource to anybody who's looking to dive into that world. But podcasts, there are so many programs out there that you can spend like $10, $20, $30, $50,000 for like a learn how to flip houses program, and I'm like, do not do that. Like, there's so much free information out there. Podcasts, YouTube, Bigger Pockets, these are the three go-to spots where you can get all of the information you need to do any of these things for free. I mean, like literally, my husband is learning to rewire our house on YouTube. Like, you can learn anything, right? Like, you can learn anything. I can do plumbing now because of YouTube. Like, it's very real. So if you have the drive and you're excited about doing it, the resources are there. You just have to go out and get them. And that's, I think, we have one more slide. I think that's about it. Yeah, so that's just my information. Actually, I passed out my folders.
I was just going to pass out some folders for you guys.
Yeah.
And we're going to have some Q&A after all three speakers. So don't worry, hold those questions, write them down. And then while she's finishing that up, I'm going to pull up Katie, our amazing, let me see here, accounting guru. Again, she's the founder of Millennial Accounting. and she'll pop up here in just a minute. I'm done speaking. But she is the founder of Millennial Accounting. She is a rock star when it comes to knowing your numbers, helping you figure them out, get systems in place so that we can have those for our business to make it easy. And then her and her team help manage a lot of really great accounts when it comes to business. So Katie, I'm gonna let you dive on in and take it away.
Thank you. I'm going to share my screen. Can you guys see my screen?
Yes.
Okay, perfect.
Yep.
Hello, everyone. My name is Katie Maddox. I'll be talking today about tax season best practices. A little background on myself. I'm the founder and CEO of Millennial Accounting, international speaker, CPA Academy, and conference instructor. I'm a certified QuickBooks Online Pro Advisor, and I'm also a writer for QuickBooks and other accounting blogs. I'm a host of the Entrepreneur Life podcast and an avid traveler and salsa dancer. So I wanted to start today by just going over my year-end financial close. And this is what we do with all of our clients and business owners before we pass off their books to the tax preparer. We are an accounting, bookkeeping, and consulting firm. We do everything from setting people up in QuickBooks all the way up until the actual tax form itself. And then we're partnered with CPAs who then take on doing the taxes themselves. But before we hand any of my clients' books over to the CPA themselves, we want to make sure all the loose ends are tied up. Everything is beautiful and perfect. So these are some of the key steps that we go through to make sure that our clients are prepared for year end. So first you want to make sure that all your bank accounts and credit card accounts are reconciled. The reason this is so important is I can't even tell you how many times we have found either duplicate income due to people adding payments and deposits instead of matching the two transactions, and then their P&L is skewed with a higher income, which then makes them pay more taxes. So we don't want that. So first, you want to make sure all of your payments and your deposits are matching, especially if you're invoicing in QuickBooks. The other reason is that's the only way that you're going to catch if you're missing transactions, which means you're missing tax deductions, or if you're missing income. And for many of our clients, we've actually found missing income due to reconciling, for example, Shopify, or reconciling some of their payment processors and realizing some of the deposits got lost in space, never hit the bank account, and the only way that we caught that was because we were reconciling the bank accounts. So I recommend that you reconcile monthly, at minimum reconcile quarterly, and always make sure all your accounts are reconciled before you get your books to your tax preparer. The second thing that we do is we run an open invoices report. If you're in QuickBooks, an open invoices report you can literally find just by going to the report section and searching on the word open invoices, and the report will pop up for you. So these are your accounts receivable, obviously, invoices that aren't paid. The reason we want to review these is sometimes we find a lot of our clients have older invoices, maybe from 1 or 2 or 5 years ago. They know they're not going to be collected on, so rather than being taxed on that information, taxed on that income if they're using accrual specifically, we want to close those open invoices out to bad debts and void any invoices that maybe the product was never shipped or the service was never completed. Thirdly, you want to double check your inventory. So we recommend that our clients take a physical inventory twice a year at minimum. We do it on June 30th and again on December 31st. So inventory is an asset account, meaning that information is showing up on your balance sheet, right? But if last year you had $100,000 in inventory, and this year maybe your cost inventory is only $80,000, you're only going to get that extra $20,000 tax deduction to your P&L if you update your physical inventory. Also making sure you're accounting for any shrinkage of inventory. We find that a lot with our boutiques, where inventory is sent and it wasn't up to quality standards, or there's a theft. It's normal to have shrinkage in the boutique world. I came out of being a corporate buyer for a big box retailer, so shrinkage was a part of my normal life. So you always want to make sure you're taking that physical inventory at minimum twice a year to account for any shrinkage or changes to inventory so you get your tax deductions. Thirdly, you want to review your fixed assets. So this can be maybe you bought a new computer, maybe you bought a new phone. So any assets that you require, we have a spreadsheet called a fixed asset spreadsheet. I know, clever. And we send it to our clients every year to make sure that anything that they bought or that they maybe had before we took them on as a client that they forgot to tell us about, that they're getting their depreciation for those assets. Or maybe they got rid of an asset and we want to make sure we're taking that off the books. We're letting the tax preparer know. One of our clients, they are ranchers and rodeo Hall of Famers, and so they buy and sell horses all the time. So we want to make sure at the end of the year is our list of horses the same list of horses as their list of horses. So always make sure you're double checking with your tax preparer your fixed asset list every year. Then we go through the liabilities and accounts payable. Obviously, accounts payable are any open bills. Make sure if you have any open bills in your books that you're making sure you still want those bills open or you're caught up on paying them. And secondly, reviewing your liabilities. Maybe you didn't break out your principal and interest throughout the year. So at the end of the year, you can make a journal entry on your books to break out that interest because interest is a tax-deductible expense. So while the principal is going to go on the balance sheet, you can make an entry at the end of the year if you haven't been breaking them out month by month to move that interest deduction over to your P&L. Then almost last but not least, you want to review your accruals. Make sure that any income or expenses that you want to mark in the right year are actually falling in the right year. We see this a lot with people who write checks. One of our clients, she always writes like 10 to 20 checks on December 31st. Nobody's cashed those checks same day, right? So they're not cashing the checks until January, but she wants to make sure those deductions are taken in December in the previous year. So you want to review all of the expenses that you had and make sure they're falling into the year that you want to take them on. Finally, you're going to review your year-end financial reports. For us, in addition to just taking a regular profit and loss report and a balance sheet, of course we review those. We review them comparatively, so year over year. We also run a general ledger and we review with the client every transaction. We're not going into every one, but we are doing a high-level review, just a spot check of every transaction for the year. And this is where we might catch things like, why did you only have 11 phone bills this year? You should have had 12 phone bills this year. So did something happen? Did you miss a payment? Did you change companies? We see that you only had 20 IRA contributions, and there should have been 24 IRA contributions. So these are the things that we're spot checking for when we run a general ledger with our clients. And then of course you want a cash flow statement so you can see where your cash went and make sure that not only are you accounting for the P&L cash movement, but also that of the balance sheet. So that's kind of everything we go through with our clients. We then write up a year-end letter that we give to the tax preparer. And I'll go into that a little bit more on our choosing a tax preparer slide. So I know most of you probably know your deadlines already, but it's good to always review them. So in the first category here, you'll have your entity type. The second is your tax form, and the third is your tax deadline. And the thing that people tend to get hung up here on is they say, well, I'm an LLC. But LLC is actually a state-recognized entity type, but it's not an IRS-recognized entity type. So when you created your LLC, you either chose, I want to be an LLC that files as a sole proprietor, or I want to be an LLC that files as an S Corp. It's really important that you know which of the two you are because they have different tax deadlines. Additionally, they have different tax forms. And that's important because when you're creating your P&L or when you're creating your books, essentially you want to use the same categories that you're going to find on your tax form. So if you're a sole proprietor or an LLC who files as a sole proprietor, the categories that you're going to be most focused on are those on a Schedule C. Whereas if you're an LLC who files as an S Corp, or you're an S Corp or a C Corp or a partnership, if you're a partnership, you're going to be looking at the 1065, and if you're a corporation, you're going to be looking at the 1120 or 1120S. And there's going to be little differences, but they're really important that your accounting professional, bookkeeper, and tax preparer are all on the same page with which one you're using. And then finally, over to the right are your tax deadlines. Keeping in mind this year, the tax deadline actually has a 3-day extension on it because of the Washington, D.C. holiday of April 17th. And then the other thing I really want to make sure that people get in their heads is choosing a tax preparer is so important. And what I like to tell my clients when they always ask me, Katie, who should do my taxes? We have different CPAs that we partner with. I speak at accounting conferences, so I literally know hundreds, if not thousands, of CPAs. And what I like to tell people is choosing a bookkeeper or accounting professional is a science. Bookkeeping is a science. It's the same no matter who you use. But taxes are an art. You could give 10 tax preparers the same set of books, and they will all give you a different tax return. That's because the IRS is very much gray. Their laws are gray. A lot of what the tax law is based on what was your intention when you did something? What was your heart posture when you did something? What was the reason that you did it, not just what you did? Is it reasonable? That's actually part of tax law, is what you did reasonable. Well, reasonable is gray. It's not yes or no, right? So when you're choosing a tax preparer, there's some different things you want to focus on. And I always tell people it's like choosing a therapist. First, you want to find someone that's in your niche, right? If you're looking for, if your business is retail, you'll want a tax preparer who specializes in working with retail clients because they're going to have to deal with things like inventory. If you're somebody who's a service-based business, or you might find that they niche by size as opposed to by industry, that's fine too. So find a tax preparer who's used to working with your niche because they will catch things and know about your industry that you might not know on your own. Secondly, choose someone that you connect with. I say choosing a tax preparer is like choosing a therapist because this is going to be a long-term engagement. This is somebody that you want them to speak your language and you want to speak their language. If they're talking to you in all tax lingo and none of that lingo makes sense to you, it's not going to be a good relationship. So you want to find someone who really can speak your language and can break things down to explain them in a way that you can receive them. Also, you want to pay attention when you're interviewing tax preparers or even someone you've worked with in the past. Are they asking questions? The best tax preparers that I work with personally are the ones who ask a lot of questions, especially because some of our clients are so complex. They have multiple multi-million-dollar businesses. They have businesses in all different industries. And my biggest client has switched tax preparers every year for the past 3 years. And the number one reason was because she said, Katie, we want you to do our taxes because you ask questions, so you know the ins and outs of our business. But our tax preparer never asks questions, they just make assumptions. And so we get the taxes and they're not what we wanted them to be. So make sure that you're picking somebody who's really trying to get to know you, understand the way you work, understand the way that your head works, so that when they're doing your taxes, they're like, okay, she did this. This is probably where she was trying to go with that. You want someone who's going to process things and understand the way that you process things. And that's how they do that, is by asking questions and getting to know the way that you think. Fourthly, you want to plan for a long-term engagement. The best taxes are done by somebody who knows you, who knows your business, who knows your family, who knows your dreams and your goals. What are you trying to do with your life? That plays out in your taxes. So don't just take somebody who's easy or take somebody who's cheap. I recommend taking somebody that you're like, this is the person I want to connect with for a long time, and I'm going to build my life with them kind of in the picture so that my tax return is exactly the way that I want it to from a long-term perspective. And finally, make sure that their level of risk is your level of risk. Tax preparers, because everything is gray, they can play around with the numbers, and that's why every tax preparer is going to do the taxes differently. So if you're somebody who's high risk and you're comfortable with that, and if you get a tax preparer who's low risk, they might not take all the deductions that you want, or they might swing too far left and you want them to swing a little bit more to the right. So you can ask them questions when you're interviewing them to see, is our level of risk on the same page? And that will make you happier when you get your taxes back. And finally, another really good way to find a tax preparer is to go on the QuickBooks Find a Pro Advisor page. This is my QuickBooks Find a Pro Advisor page. Obviously, I don't do taxes, but we are partnered with tax preparers. So even people, when they need taxes, they reach out to me and I just connect them with our partners. But you can, if you Google QuickBooks Find a Pro Advisor, a QuickBooks Pro Advisor is somebody who's certified, and you put in your zip code, it'll show you all of the accounting professionals and tax preparers in your area. It shows you what their niche is, it shows you what services they offer, and if they're a pro advisor, that means they're already certified. So it's an additional way to kind of have a double check on someone, to not just pull somebody off the street to do your taxes, to see what their experience is outside of maybe a Google search. And then just finally, if you are at the point where you're like, I have a business, but I'm not in QuickBooks yet, or I'm still just getting started, there's a template on my website. Most of these templates are for accountants, but this one in the bottom, it's called the Income and Expense Tracking Worksheet. And if you're somebody who needs a little bit of a help getting there, it's just a little messy, you don't want to commingle anymore, you can download the spreadsheet, and it just tells you what the Schedule C specifically, Schedule C categories are for the tax return, so that even before you get into an accounting software, you can kind of start planning, okay, this was my income for the year, this was my expenses, and then this is how I should give it to the tax preparer so that it ends up in the right place. So, if you guys have any questions, I'd love to answer your questions during the Q&A. If you need my contact information, it's up here on the first page, and I hope you found some value in this presentation.
Awesome, thanks Katie. We will jump into questions in just a little bit. And last but not least, we have Eureka Wakelam. She is going to be chatting all about financial investments and really setting yourself up for your future. So let's give it up for Eureka.
Woo! If everyone will just stand up real quick, high five your neighbor, right? If you don't feel overwhelmed yet, then just hold on a minute, right? Because honestly, I am obviously sitting here in the same boat as you guys, right? And learning these things, it feels like a fire hose, doesn't it? If you are not familiar with the financial lingo, whether it's in real estate or taxing and accounting or investing, it can feel like a lot of information. And so I just want to congratulate each and every one of you for being here, for taking the step and investing in yourself and learning, because a woman empowered is a force to be reckoned with. So congratulations, I'm so glad you guys are here. So I get the privilege, sorry, I'm just gonna pull up my slides so you can kind of keep tracking.
I'll pull those up too. I forgot
Awesome.
about that.
So there's a lot to go over. Just to introduce myself a little bit, my name is Eureka Wakelam. I have 4 beautiful children and an awesome husband. I'm a former nurse. I still keep my license because my mom, who's here, is a practitioner, and so who doesn't like to, help each other out when needed? But I decided late in the game that definitely wasn't for me, right? And so my husband and I kind of talked about it and said, what can we do together to fuel our family to where we can actually see each other? And so we decided, just long story short, God brought finances in our way and we just jumped ship. And we got, fully licensed and just went in the deep end and said, look, we have to learn this stuff, right? We trade our time, our energy, our health to learn about how money works, and yet there seems to never be enough information, right? We always everybody knows how to get a paycheck, but most people don't know what to do with it, right? So my goal today is to teach you how to think about money, right? The principles about how money works. And in order to do that, we're going to talk about how life works. So I'm going to use the theory of decreasing responsibility to illustrate that. So if you'll notice, on the left, right? My left, right? Your left, whichever. Right in the earlier days, when you have young children at home, like most of us find ourselves in this place, when you have young children at home, a little bit of debt, a mortgage, credit cards, things of that nature, most people are not saving a ton of money during this stage of their life. Right, you have children, sporting events, a car that comes up, all kinds of things. In the earlier stages of life, most people don't feel like they have a ton of money to save. But then what happens is as the years go on, and as you age and your kids get older, you know, they move out of the house, you start to pay off your mortgage, hopefully you become debt-free. At that point in time, your responsibilities go down, right? But your need for income goes up. And so in the later stages of life, most people, are they working more or working less? The goal is to work less, absolutely. And so the idea is that there is what's called the theory of decreasing responsibility, meaning as time goes by, your responsibilities should become less and less. But unfortunately, right here in the middle, we see that I would say an unfortunate thing happens in the middle. Is that most people, the stats are, get to about 45, 50 years of age, and it's at that point that they actually start thinking about saving for retirement, right? And if you're closer to retirement, do you have more time to gain money, to accumulate it, or less? Less, right? And so the idea is that we have to start taking control of the things that we, sorry, you want me to? We have to start thinking about what we can do in this whole process. So we don't focus on the uncontrollables, right? Because there's things that come up that we absolutely have no control over. So we're going to focus on the things that we can control. And what we can control is shifting our mindset. The most important thing is to pay yourself first. People always think about, hey, as the money comes in, you're, paying your debt, paying your bills, kids stuff, whatever it is. And then at the end of the month, there's never enough money left over. Well, the goal is to shift the way that we think, to adjust our priorities and pay ourselves first, right? We have to change our thinking and adjust our lifestyle, right? Most people, when you get to the end of the month and you ask yourself, where did the money go? Most of the time we don't sit there and ask ourselves, well, was that extra run to Starbucks really necessary? Right? Or was that second pair of shoes really necessary? So we have to start adjusting our priorities and adjusting our lifestyle. And we have to start earning additional income, because sometimes it's not that you are frivolously spending, right? Because there's a lot of people who are very frugal and there's just not enough. And so in those situations, getting a side hustle, right? Like maybe taking on some extra hours, doing whatever you can to supplement an additional income is very, very important. And of course, avoiding the credit card trap and setting goals and having a plan. Now, why is this so important? Nice, thank you. And here is my very, very favorite way to kind of illustrate this concept called, time value of money. So we're going to talk about two brothers, right? Two brothers, let's assume that they were twins. And you've got brother A and brother B. Now, brother A met someone like me who encouraged him to get in the market, right? Make sure you start putting your money in the market. And brother A, by the time when he was 22 years of age, super early, he invested, he maxed out, it was probably an IRA or something, $6,000 a year for the first 8 years of his life. He just maxed it out, right? He put everything he could in there, maybe, whatever. 8 years later, something happens, I don't know, he bought a home, maybe got married, who knows what it was, but all of a sudden he said, I'm going to stop contributing. I'm going to leave whatever money I put in there, but I'm going to stop contributing. Well, brother B, right, decides, well, I can't let my brother beat me, right? He's already in the market. I've got to get it to the market. And then the competitive spirit came up in him and said, but I'm going to outdo him. I'm going to start putting in max contribution for the next 40 years of my life, right? And totally whip my brother. Now, who would you assume ended up accumulating more money? Brother A or brother B?
B.
The assumption is brother B. But here's the crazy thing about time and compounded interest, is that in fact, brother B contributed $282,000, right, over the course of these 40 years. Brother A only contributed $48,000. But brother A, at 67 years of age, ended up with $2.2 million, whereas brother B only had $2 million. Is that crazy or is that crazy? Right? Because when you look at brother B, 40 years he contributed, max contributed, and he had less money than his brother? Why is that? Because of compound interest in time. When we're talking about money in the market, that time value, it is crucial to make sure the sooner you're in, the better, because of compound interest. This is why you want your kids super early to get in, why your brother, sister, neighbor, whoever it is, get in the market, even if it's $100, because as far as time is considered, it's a game changer, right? And so obviously, there's different phases of investing. So, okay, awesome. So obviously we didn't go over compound interest, we'll have to do that at a different time, but it's the idea that your money grows, right? It's not just the initial investment, it's the initial plus the interest that it grows, that's what snowballs. Which is why you can have an initial amount and not contribute for 40 years and it grows, like significantly, right? So there's different phases of investment. There's the accumulation phase, there's the protection phase, and the distribution phase. Now during the accumulation phase, which is obviously you see it's between 18 to 55 years of age, this whole phase is the accumulation phase. There's different stages that happen for each person, and there's different risks within that. What I want you to understand within here is that during this phase of accumulation, you have to have certain barriers in place. You have to have certain protections in place. Because when you're accumulating money, if you have a spouse, a family, something of that nature, you want to make sure you have some kind of protection, some kind of life insurance, something that protects your investments and your money, right? Because say, for example, if it's you and your spouse or you and your kids, and your goal is to hit here, age 65, where the distribution phase happens, the income phase happens of it, well, what happens if one of you passes in between? Well, that accumulation stops, right? You no longer hit those goals that you were intending. But if one of you passes or something of that nature happens, heaven forbid, you're still able to fund that and get to your goals and dreams that you're after during that phase, right? So the protection phase is very, very important during the accumulation phase prior to getting to the point of distribution where you're actually drawing in income from that. Awesome. So what type of an investor are you? We just heard Katie kind of talking about the whole concept of whether you're conservative, whether you're moderate, or whether you're aggressive. Now, it's really, really important to be sitting down with somebody who understands who you are emotionally, right? What it means to you. Somebody who's not emotional about your money, but can help you pick the different types of funds that are going to meet your needs. Because if you're conservative, obviously you'll want municipal bonds, different things like that. Or if you're moderate, you want large cap. Or aggressive, you want really good mutual funds. So knowing the type of investor you are is crucial, and it's so important to make sure that you're sitting down with somebody who, like Katie said, is asking you questions, is invested in your goals, in your dreams, but also understands that there's an emotional aspect to this. Awesome. So obviously we talk about not just saving, investing. So rate of return is key. It's key, guys, right? And why is it key? So I'm going to use this illustration here of the Rule of 72. Now, most of us have kind of heard of the Rule of 72, and if you haven't, it's just the banker's rule, right? Most big banks, big companies understand what the Rule of 72 is. Just your interest rate divided into 72. It'll tell you the amount of time that it will take for your money to double. Now, when you look at the Rule of 72, when you look at the different interest rates and why your rate of return matter, interest rates, I keep saying interest rates, but I mean rate of return, right? You have, say, 3 brothers again, okay? We're going to use siblings again. And each sibling has $10,000 that they got from mom and dad that passed away. Now, brother A gets his $10,000 and he says, awesome, I'm going to take that money, I'm going to put it in the bank, and I'm going to get 3%. Now, which one of you is actually getting more than 1% in their bank? Awesome, right? But not likely. Most banks don't give you more than 1.5%, almost 2%, right? If that. So, pretty fair example, right? So they put their $10,000 in the bank and they're expecting, hey, it's going to grow over time, whatever. Brother B decides, you know what, I'm going to outdo my brother. I'm going to take that $10,000 and I'm going to put it into a CD, right? Into a money market. And his $10,000, because he's getting 6% rate of return, his money doubles every 12 years instead of every 24 years, right? So then you take brother C, and he finds somebody like me, right? And he puts his money in the market. And he takes his $10,000, and because of that 12% rate of return, his money is doubling every 6 years. Now, why is that important? Because brother A, by the time he's 48 years old, like really, how many 24 doubling periods does somebody have in their life? 3, 4, 5 if you're really healthy and lucky, right? But the same investment over the same amount of time, you have somebody who can't retire to somebody who's at 2.5, right? $1 million who retires with dignity. Big difference or little difference? Huge difference, right? So rate of return matters. Now, what different types of investments are there, right? We work with mutual funds, we work with annuities, managed accounts, IRAs, Roths, 403s, college saving plans, 401k for businesses, SEPs and simples. Now, there's all these different types of things. And all this means nothing to you if you don't know what you want it for, right? Because at the end of the day, knowing that there's a lot of different options on the market is not as important as knowing what you want to do and which account best fits you, right? My friend says, I have a friend who says, when somebody asks her, what's the best vitamin to take? The one you'll take, right? Well, what's the best account to get into? The one you'll be consistent with, right? And the one that best fits your needs. There's typically 3 different types of accounts that we focus on. Within each one of these accounts, just so you know, the different types of funds that we showed you, the slide before, fits into these different types of accounts. But to simplify it for you, to kind of wrap things up, the 3 basic accounts that you'll want to focus on is an emergency fund, a short-term savings, and a long-term savings. Now, within each one of these, there's different things that are applied. Emergency funds are things like 6 to 3 years of something, right? If something were to happen, you have an emergency, something of nature, you want to put it in this type of account. The second type of account, like a short-term savings account, would be something like a house fund. I want to buy a house, take my kids on a dream vacation. I want to, buy, I don't know what. You put it into a short-term savings account, right? Like a flex fund or something of that nature. And then, of course, you have long-term savings account, which would be IRAs, right? Roths. Anything of that nature that is going to be long-term, something that you will not be touching. Now, the importance of having these 3 types of accounts is because you don't want to end up putting all of your money into one account, and then when things hit, you end up touching this account, and what happens to your compound? It ceases, right? And starting with large chunks is awesome. But the truth is, you're going to get a lot further having minimal contributions or as much as you possibly can over a longer period of time, but making sure that you're not touching it, right? That's why we set up different accounts. So for the other things, for the other fun stuff that comes up, for the emergencies, for the short-term things. So guys, finding somebody that's going to be in your corner that's really going to ask you questions about what you're trying to accomplish is super, super important. And find someone who really you emotionally connect with that's going to be involved in your children's life and your grandchildren's lives. Because the chances are, when you get to this stage and you yourself are wealthy, then who gets that? Your kids, right? And then their grandkids. And you're setting up generational wealth. Just like the slide before with brother A and brother B, starting early is everything. And the one thing I want you guys to take away from, because when you're looking at all these things, initially the first thing that comes to most people's mind is, that's a lot of money. Where am I going to get all this extra money to put in the market? And really, if all you have is an extra $100 to put in, that extra $100 can be allocated properly to where it compounds, and then you will, start learning that habit. Because really, when it comes to the money game, the most important thing is your mindset. It's believing you can, knowing you should, and understanding that a little seed sown every day, right, or every month, will produce a beautiful orchard. And so the last thing I want to leave you guys with is just telling you, you can do it, okay? Believe that you can do it. You can get out of debt. You can start saving. And most importantly, you can become wealthy. And I will even, go out on a limb to say you should become wealthy. We're in the richest country in the world, right? You should. If you're learning this today, it means that you should definitely take a step and take a bet on you. And try your hand at things. This is for you too. So thanks so much, guys, for having me.
Love it, so good. Let's give Eureka one more round of applause. And I'm gonna pull up one other thing. We're gonna quickly dive into a budget for business growth. Now, this is kind of a fun thing that you can either take a screenshot of if you want with your phone, take a picture of it. You may or may not have time to jot down everything on here, but when it comes to a budget for business growth, there's different allocations when it comes to just budgeting for regular business maintenance or even just your home financial maintenance, compared to actually allocating money and different percentages when it comes to growth. So if you can take this, so we add in your year and for your annual revenue goal that you have. And then what we're gonna do is allocate the revenue in different ways, okay? So this first one, we actually want to allocate 10% of your budget for business growth, your goal, for mentorship, for growth, for events, for masterminds. That is where you are going to grow you. That's where you're going to bring on the financial coach. That's where you're going to work with the real estate investor. That's where you're going to get into groups like this, right? Spending money on events. You're going to get into masterminds so that you can work on the different mindsets as well as get the fast track for learning different techniques that you want within your business. The next one, if you have team employees or contractors, assistants, this is where you start to build your team. You're going to want to allocate 25% of your annual revenue goal for growth. Now this is a big thing. How many of you are solopreneurs out there? Like it is you, yourself, and I. You are the marketer, you are the photographer, you are the social media manager, you are all the janitor, you are all the things to all people, right? Stop doing that, okay? The hard part about that is there's this truth that lives in the tension of when it comes to being a woman in business, an entrepreneur, a small business, is that we have to figure out the balance of trading time for money or doing all the things and bringing on people that can do things better than what we can, right? So how many of you guys are accountants in here? Okay, we got one accountant, all right, yay, right? So if you are not an accountant, how many of you get really frustrated by accounting and numbers and figuring out, trying to do the spreadsheets and the QuickBooks and yes, 95% of the room, right? So instead of you doing it and spending hours trying to do it, hire Katie, right? Hire another professional because they're going to do it better than you, and then you can reallocate that time that you're spending to stay more in your zone of genius, and you will actually get paid more. Now here's an example. So I actually used to own a wellness studio here in town, and when I first started, I was, like I said, all things to all people, okay? I was the janitor, and I was scrubbing the floors, and I was the accountant doing the bookkeeping, and I was the personal trainer doing the personal training, and I was on social media doing the marketing, and I was out in networking events meeting people, and I would write, like, you name it, I was doing it, and I was exhausted. And what I figured out was when I was personal training, I could charge $100 an hour, but then I'm like scrubbing floors where I could pay someone like 10 or 15 bucks an hour, right? So now all of a sudden, when I'm scrubbing floors and keeping my gym clean, which is a good thing, right? Now instead of me taking those few hours, whatever, a day or a week, I'm now outsourcing it to someone, and I can fill my books at $100 an hour as a personal trainer, right? So now I'm making more, and I'm not doing something that I hate, like scrubbing floors. Make sense? Okay, so my encouragement for you is you want to make sure you are allocating that budget for your team, because this is going to help you grow and scale and actually have fun in your business instead of do things like scrub toilets. Okay? Next one, marketing, growth, audience acquisition, public relations, ad exposure, those type of things. That's where you're going to want to allocate 20% of your budget when you're working on growth for your business, okay? So this is where you are acquiring audience acquisition, you're acquiring people onto your email list, you're acquiring an audience that actually is an audience that you own, right? Because when it comes to social media, your audience, you don't own it. right? You could get what I like to call the Zuckerberg slap at any time, right? The algorithm could shut you down. You could post whatever about chickens, and then they're not gonna like show your stuff. And typically, when it comes to your social media, less than 10% of your audience is actually even seeing your stuff. And so it's because it's an audience that you rent. Like I remember at the end of 2021, my Facebook account actually got hacked, and when I went to go confirm that it was me and show my driver's license and all that fun stuff, they shut it down because there was a hacker that hacked into it, and I was never actually able to recover it. So I lost it. I had my over 5,000 friends, over 20,000 followers, and all that. So like that business asset, quote unquote, was gone. And I saw my email list, right? So I could still communicate with customers on the groups that I had started, all the pages, like everything gone, right? And so I had to start from scratch when it came to audience acquisition on Facebook and groups and yada yada, right? So an audience that you own is your email list, your text list, and if you're sending out newsletters, your mailing list, that type of a thing, okay? And you want to make sure that you are acquiring those leads, otherwise your business will, yes, referral is great, keep doing those, referrals are one of the best ways to do it, but you also want to make sure that you are getting exposure through things like PR, through ads, through marketing, and then really making sure you're building your email list. Surprise is good and bad. You want to allocate 5% of your annual budget and your revenue. So that could be the fun little extra thing that I want to do for my clients, or the fun little mastermind that popped up and I can go to it, or oh crap, my thing broke down and I have to pay for it. So you want to allocate that budget for 5% for good and or bad, and to be able to utilize that right away. And then your paycheck, so then what you pay yourself. And again, this is for budgeting for growth. So yes, pay yourself first, and when you're budgeting for growth as a small business owner, you want to pay yourself first, with that 40%. And again, as your business grows, because you're acquiring leads, because you are growing yourself with masterminds, because you're bringing on contractors and growing your team, then that 40% will obviously grow as your business grows. And then you can work on those numbers, right? So simple math, so you've got your big number, it gets broken down into smaller numbers, and then you start to allocate your revenue in the different ways. Now, if you are a product provider, obviously adjust accordingly for products in there, if you're doing different things as far as inventory. And then you can allocate, okay, maybe in quarter one, right, January, everyone is gung-ho, gangbusters. Quarter one might get different allocation than quarter two versus quarter three versus quarter four. Okay, so you can utilize this budget for business growth to project even this year and see where you can work towards it, right? You might not be able to do this right away, but what little tweaks can you do regarding this budget to be able to work towards the resources that you need for growth and to be able to stay in your zone of genius and stop scrubbing toilets and floors. Okay, makes sense? So we are going to dive into Q&A to round us out. So if you guys have any questions regarding anything that we talked about, any questions you might have regarding finances, accounting, real estate, financial investments for your future, anything like that, I'm going to pull up Katie's beautiful face here, and we are going to dive into a few questions. All right, anyone want to start? Wow, not everyone at once.
I know, right?
I have a question.
Yes.
You talked about bigger pockets, so this question is for Molly. Can you explain a little bit more about what bigger pockets?
Sure. So I'm just going to repeat the question so that our online audience can hear as well. So what was your name?
Sharon.
Sharon asked about bigger pockets and what type of a resource it is for real estate investing.
All yours.
Thanks. So Bigger Pockets is a website, like biggerpockets.com, but they have a podcast, and that's how they really got big. Their podcast is amazing. I mean, you could learn everything pretty much you need to know about real estate investing if you just had the hours to listen to just endless amounts of podcasts. So it has multiple resources. So there's the podcast, there's the website. So the website actually started as a forum. So real estate investors would go in and be like, hey, I just inherited $400,000. Like, what's the best use of my money? How am I gonna, retire in 5 years? Like, how would you place that? And then people who are more experienced would hop on and be like, here's what I would do, and you get different perspectives. And so that still exists and is like just an incredible wealth of information. You can search the past forums, you can post current questions. What I, to this day, use the Bigger Pockets for the most is the tools. They have like calculators. So like when I did my first professional flip, I went in there and I used their calculator, plugged in, what I was budgeting for every, renovation, for surprises, for things we were going to do ourselves from contractors. Like you can plug it all in there. Holding costs, if you're going to be holding the property for 6 months while you fix it up, you have to calculate in, how much your mortgage is during that time, and really helps. It has the space for you to put a number, and so it's like, oh yeah, right, that I forgot I was going to need to pay for that during that time, and so it really helps, especially as you're getting going and learning to know what you're going to need to allocate funds for. And so then when you run the numbers and it's like, hey, it looks like I'm going to make $100,000 on this deal, and you've filled in all those boxes, you have a different level of confidence because it's like, even the computer says I'm going to make money. And obviously I say, run those numbers with somebody else as well. Like talk to somebody who's done it. Say, hey, here's what I'm looking at doing. Here's what I see. Like, do you see that I missed anything? And run those. But yeah, you can do it right there on the forums, even if you didn't have somebody in person. But yeah, it's such a great tool. I absolutely love Bigger Pockets. I'll promote it all day long.
Love it. Anyone else have any questions?
Could you explain the acronym for BRRRR again?
Sure.
The acronym for BRRRR is the question.
Yeah, so it's buy, rehab, rent, refinance, repeat. So you buy it, you rehab it like it needs, we call that like a value add. So you're going to go in and improve the property to increase the equity of that property. That can be through renovations, but it can also be like, for example, one of our properties we bought had a commercial space in it in a place that nobody wants commercial space. And so we converted that into a residential unit. So that was not a cash flowing part of the building initially, and we've now turned it into a cash flowing part of the building, which increased, our investment incredibly. And so there's ways you can do that value add in that rehab, and then obviously rent it, get your leases in order, go out and refinance it, get your money out, and go do it again.
Anyone else? No. Do you ladies have any questions for each other or any last minute thoughts or words of wisdom before we close out?
Can I share just a little plug for my real estate investing meetup?
Yeah, do it.
So every month we do an investors meetup. It's on the third Wednesday of the month. We meet at Cafe Olay in Boise, and it's just a time that we sit around, and we actually do every other month, but it's more focused on networking versus bringing in like a speaker or having like a specific subject that we will deep dive on. So like we've done, deep dives on like out of state investing, like how do you run deals, figure out markets that are not your own, like how do you figure that part out, So deep dive into some of these subjects that, maybe you didn't get enough on the podcasts or something like that. And then every other we do just networking, like sharing information with others, sharing deals that we're doing. And I swear we've put together so many deals just in that room. So we'd love to have you come join us and be a part of that.
Love it. Katie, any last words of wisdom about numbers and business and keeping track and all of the amazing things that you do? Oh, you're on mute. No. Do you have any last words of wisdom for... Oh, sorry.
Last words of wisdom?
Yes.
I would say last words of wisdom is just don't wait till the end of the year to look at your books. Like hire a professional. At minimum, have somebody that does it quarterly. If you're too small to have somebody in your books every month, but at minimum, have a professional look at it quarterly so that you actually are able to get value to change things that you need to change before the end of the year and it's too late and you're just looking back on things that you could have fixed.
So good, I love that. Eureka, any last words of wisdom?
Yeah, so kind of along the same lines as far as like putting together a plan. You know, most people spend more time planning a birthday or a wedding or something of that nature than they do their financial future. And getting a plan together, like figuring out what your FIN number is, what's your financial independence number. Most people don't realize that they actually could retire, 10, 15, 20 years sooner than they actually, than they originally would have if they actually put a plan together. And making sure that you have a GPS to do it. Kind of like what Molly was saying as far as that calculator, like a plug and play. When you actually know what your numbers are and when you know what you're shooting for, it gives you a completely different zeal to save or to readjust some things or taking on an extra, putting your energy into something else. Often you won't do that if you don't know what the goal is, right? It's like, well, what am I saving for? Like, what does that even look like? How close am I? So just get a plan together and, really just see it. And seeing sometimes is believing, right? Most of the time, unfortunately. But yeah, put it together a plan.
So good, so good. Well, thank you guys so much. And actually, I want to make sure that everyone knows these ladies' Instagram handles, so if you want to reach out to them and connect with them, obviously while you're here in person, you can connect with them. And for our online audience, you guys make sure that you find them, follow them. They just give a really great wealth of knowledge and make sure, right, this is like the launching pad to get you started into further conversation, right? And Lunch and Learn, it's a really fun way to, yes, connect and to get really great information at the top of the iceberg, but obviously we want to dive deeper and we want to dig deeper into these different conversations and resources. So Viorica, what's your Instagram?
It is Viorica Weight Club.
Viorica Weight Club.
So Viorica, Weight Club, W. Again.
I got it.
Sorry, okay. So Viorica, WAKELAM.
Molly.
It's Molly Arnott Realtor. So Molly. And my last name Arnott is ARNOTT. And then Realtor, REALTOR. Molly Arnott Realtor.
Love it. And Katie, what's your Instagram?
My Instagram is Katie Maddox, KATEYMADDUX.
Awesome. And I'm Charity Majors or Business and Bubbly. And yeah, fun resources as far as just continuing conversations like this and just really, like my big thing is I love to give women like these platforms to be able to share their genius and then provide spaces like this for women like you to be able to learn and grow and connect. So that's what Business and Bubbly is all about. We've got a fun podcast. Come jump in with our networking groups. We've got online groups and in-person groups. And we just want to thank you guys for joining. If there's food out there, you can feel free to grab some food to go. Make sure you connect with someone as you leave. And thank you guys so much for coming to our Lunch and Learn. We'll see you guys next time. Bye guys, thanks for joining.
Yeah, he's gonna be my replacement.